Hi, I'm Garrett Cayet, SFMG's Chief Investment Officer. I want to talk about the conclusion of 2022 and how we're looking forward to 2023. So in the final quarter of the year, there appeared to be a tug of war between inflation reports and central bank policies and rhetoric. The stock market broadly rallied through October and November, but stalled out in December when it was dealt a combination of slowing economic data, negative corporate earnings guidance, and most importantly, the Fed remaining committed to their aggressive hiking cycle. And although the fourth quarter ended up being the best quarter of the year, 2022 overall was the worst year for stocks since 2008 and the worst year for bonds in decades. The S&P 500 was down roughly 18%, and the Bloomberg US Aggregate Bond Index was down about 13%. In fact, it was the first time that both asset classes produced negative returns in the same year since the 1960s. But getting into 2023, we're looking for inflection points on some of the items that drove asset prices lower in 2022, like the Fed and inflation. First, inflation is showing signs of peaking and declining. The consumer price index is down from a high of 9.1% in June to 6.5% most recently in December. And while that number is still much too high in an absolute sense, if that downward trend continues, and perhaps at a pace that's better than expected, that should benefit asset prices through the year. And as for the Fed, after their historically aggressive interest rate hikes in 2022, we do appear to be getting closer to the end of that hiking cycle. The Fed indicated that they expect the peak interest rate to be about 75 basis points higher than the current Fed funds rate, meaning we may see the end of their hiking campaign sometime in the first half of 2023, which should benefit asset prices as well. But despite those potential positive resolutions, we still very much expect that the economy will be tested in 2023. All those interest rate hikes from 2022 have not been fully felt by the real economy yet. And if inflation stays too far above the Fed's target of 2% for too long, we may end up with an extended tightening cycle, more pressure on corporate earnings, and the potential for a more severe recession. But we remain focused on identifying the long-term opportunities that the historic declines of 2022 may be creating. Many individual stocks and areas of the market, like small caps, appear to be trading at discounts to fair value. And with interest rates in the 4 to 5% range on high-quality corporate bonds and treasuries, that income should provide some cushion for any future volatility. But we remain in a bear market, and the bottoming process for stocks is ongoing, so it may take longer than usual for any sustainable trends to develop. Finally, if you have any questions about our outlook or your portfolio, please feel free to reach out to your SFMG team. Thank you.